As investors, we often look for ways to maximize returns and minimize risk. One approach is to try to identify skilled fund managers who can outperform the market. However, a recent study by Dimensional Fund Advisors shows that such a strategy is not likely to be as successful as we might hope. The research, which is called DFA's Fund Landscape Report, analyzed returns from a large sample of U.S. domiciled mutual funds and exchange-traded funds over a long period. Today, we're fortunate to have with us Michael Humbert, an investment strategist with Dimensional Fund Advisors. Hi, Michael. How's it going?
It's going great, Murray. Thanks for having me today.
You betcha. The latest edition of the Fund Landscape Report revealed that a majority of fund managers failed to deliver benchmark-beating returns after cost, didn't it?
That's exactly right. We've done this report for a few years. Every year, we look at the landscape of mutual funds and ETFs, and we try to assess performance of these managers relative to their benchmarks. And the study from this year revealed, consistent with prior years, that managers tend to not outperform their benchmarks after considering costs.
Okay, and this is pretty much all U.S. mutual funds, U.S.-based mutual funds and ETFs. You had almost 5,000 total.
That's right.
Yeah.
U.S. listed mutual funds, but funds that invest in the U.S. or invest internationally, equity funds, fixed income. The sample size for this and the amount of funds is in about 5,000 funds. You hit the nail on the head there, but across asset types.
Yeah, and that's fixed income, international equities, U.S. equities, the whole bit.
The whole bit.
Okay, and that was trillions of dollars in total market value. But one of the things that I think it really points out is that trying to outguess markets, you're going against so many millions of other investors, and you're really working against the market structure, which is built around prices, correct?
Traditional active management, the value proposition there, they're trying to find those mispriced securities and buy them and where the market has it wrong. And the question isn't whether the market has it right or wrong. Prices reflect the aggregate expectation of millions of investors, processing those expectations, their bets for the future across trades every single day, hundreds of billions of dollars of trades. So the task for active managers to outperform this very efficient information processing system is enormous. We should expect them to underperform given the size of this task, and we see it in the data as well. Managers who survive and outperform over varying horizons, 10, 15, 20 years, they survive and outperform less than would be implied by chance alone.
So you have to assume as a investor going into the stock market or bond markets that prices are a fair barometer of how the market values the securities.
Beginning with prices, we believe, is a great investment philosophy. Starting with prices and using them to position yourself towards outperformance is something that can help you outperform the market without having to outguess it.
Okay. And one of the great statistics I love from the Fund Landscape Reports looks at disappearing funds or survivorship bias, correct?
You have to account for those funds that disappeared over these horizons here because they represented part of your opportunity set, funds that you were evaluating over those 10, 15, 20-year horizons ago that we discussed. And so considering that survivorship bias, those funds that closed or were absorbed by another fund in your sample is an important consideration for identifying, really the persistence of performance.
And it's not a small amount either.
No, it's not. People may be surprised to see that because the size of the market has grown over time, but hundreds, thousands of funds close every single year. The sample and new ones launch as well to replace them. So really accounting for that survivorship bias is one of the challenges and one of the benefits of a report like the Fund Landscape.
Yeah. The other part of the landscape report that's very interesting is how equity funds or fixed income funds, past performance is just not a real good way to predict future results.
Absolutely. We don't see information in past performance that helps you identify managers who may outperform going forward. And of course, there are managers that are more skilled than others, right? There is a varying degree of human ability there, and that's part of it as well. But identifying that when you're making your investment choice, it's really difficult, if not impossible, to identify those skilled managers using past performance, and then or bifurcating that luck versus skill component. There is a lot of noise in equity and fixed income returns. Those managers who are in the top quartile over a 5-year period, they don't necessarily stay in the top quartile over the next 5-year period. In fact, we see generally plus minus a few percent, but only about 20% remain in that top quartile, remain in the top 25% of fund managers. So well less than chance alone. And this informs us that of the enormous challenge it takes to outguess market prices.
Yeah, and higher trading costs also impact returns, correct?
Trading costs can impact your returns. There's implicit costs and how you trade that can impact your returns. Even if we look at something as visible as the expense ratio, though, right? Something very practical and that every investor knows and anchors themselves on. We look at those funds with higher expense ratios, and they have even a lower survivorship and outperformance number than the category as a whole. So those funds that have higher costs, intuitively, this makes sense, right, Murray? Those funds with higher costs, they have a higher hurdle to outperform their benchmark. And so investors should be considering the costs, those headline costs, those explicit costs like expense ratio, but also the philosophy and how they trade and how they impact markets on the implicit cost side as well.
Okay, so I'm going to throw you maybe a softball question. How does DFA put this all together?
Absolutely. We don't try to outguess prices. We start with price and use that information contained within market prices, updated in real time every single day, to position ourselves towards those segments of the market that are expected to outperform, towards the size, value, and profitability premiums within equities, and then the term credit premiums within fixed income, while also considering varying currencies and the shape of the curve within fixed income as well. And then when we trade, we do so in a patient and flexible way. We're going to blend in with the natural liquidity of the market, making sure that when we trade, we try to have a minimal impact on market prices and make sure that we have approach trading each and every single day with flexibility, with optionality.
Sure. And I should mention too that funds from Dimensional Fund Advisors do represent our favored fund family at IFA. Thank you very much for your time again, Michael.
Thanks for having me, Murray.